right, welcome everybody. Thanks so much for being here. Great pleasure to see many familiar faces. So thanks a lot. Welcome to the annual conference of the Stone Center on Global Wealth Dynamics. I'm Gabriel Zachman. I'm a professor of economics here at the Paris School of Economics and École Normale Supérieure, and also the director of the Stone Center. So just a few words to start with about the Stone Center. So the Stone Center acts as a facilitator of research on inequality here on the PSC campus, working closely with the big community of researchers and students involved in that area, and the different labs, the World Inequality Lab, the EU Tax Observatory, the Institut des Politiques Publiques, all of which are co-organizers of this conference today. And so for this inaugural conference, we thought that it would be good to talk about what I think is a pretty topical question, which is the question of the taxation of billionaires. When thinking about these remarks, I was reminded of the work that with my colleague Emmanuel says we did in the US about 6 years ago, where we produced the first study of how much tax billionaires pay in the US, trying to combine the various evidence on this issue. It was published in a paper by Brookings, and then in our book, The Triumph of Injustice, in 2019. And it made quite a splash at the time, because we found that billionaires in the US had relatively low tax rates when you take everything into account. And when you compare that to what the middle class pays, they paid even less tax than the working class or than the middle class in the US. And it was quite a bit of a shock in the US, a country that prides itself with having a progressive tax system, with having a big progressive individual income tax and no VAT, in contrast to European countries. And it's been really a pleasure to see that this research agenda has blossomed in the years after that, and there have been many studies conducted in countries such as France or the Netherlands or Italy, Brazil, and a growing number of countries, and we're going to learn about all those studies today, trying to do similar computations with often much more and better data than what we could use in the US 6 years ago. In many ways, this research agenda is just the continuation of very modest extension and continuation of long-standing work on the distributional analysis of the tax system that was pioneered about 80 years ago by economists like Serge Christophe Kolm and Richard Musgrave in the US, and then have been many studies over the past decades trying to estimate how much tax the different groups of the population pay. And I guess the main specificity of what we've been trying to do, and what we'll hear about today, is the focus on the ultra wealthy. Why is that important? As for various reasons. One is about research and economics, which is that as is often the case in economics, focusing on extreme cases, on edge cases, is important to think about key issues, highlight some of the limitations of the way we tend to think about taxation or about inequality, and forces us to question our usual methodologies and assumptions, and to improve our measurement systems and our conceptual frameworks. So that's useful in that way. The idea behind that conference was, on day one, to try to bring together this big and growing research community to learn from each other, to learn about the different methods that are implemented in different countries, to think about how we could harmonize these methods, and also to think about how we could make the sum, the whole bigger than the sum of its parts. So we're going to learn about various case studies, various countries today, and as you hear about those presentations, I'd like you to think about how we can take it to the next step, make it bigger than the sum of its parts. And I think that's one important objective, at least for day one of that conference. Day two is going to be about policy. So this is largely motivated by what has happened last year at the G20 under the presidency of Brazil. The Brazilian presidency, as you know, put on the agenda of the G20 the idea of having a coordinated minimum tax on ultra-high net worth individuals. And that was really, I think, important in many ways. It was the first time since the G20 was created in 1999 that issues like tax progressivity, like inequality were put on the agenda of the G20. Presumably these are some of the most important issues for the international community and questions that require a great deal of international coordination, and yet they had, these questions of how to tax the super rich had never been discussed in such forums, or they had never been discussed at the G7 that was created even farther back in time in 1975. So that in itself was very significant. I think it was especially significant since those discussions, in my view, perhaps, if I'm optimistic, can be viewed as a kind of embryo for a new organization of international economic relations, which would put the fight against inequality at its core, and an organization, a new form of international economic cooperation, which would be more sustainable than the kind of free trade paradigm that we've had since the 1980s with its many flaws, or more sustainable also than the coercive and uncooperative model, which is making such a spectacular comeback today. So it was important for that reason, and I think it has had some influence. We are seeing now the debate about creating a minimum tax on ultra-high net worth individuals gaining steam in many countries. For instance, in France, in February, the French National Assembly voted a bill to create a minimum tax of 2% for individuals with more than 100 million euros in net wealth, which was, the proposal that had been discussed at the G20 last year. I wrote a report for the G20 presidency to detail this idea, to examine its feasibility, and to think about the potential revenue involved and the value added of having international coordination and cooperation on these issues. But now we are seeing this debate gain steam not only in France, but also in a growing of EU member states where similar ideas, similar bills are going to be introduced in the coming months, and beyond the EU, in Latin America, and in fact all over the world. I think the main specificity here of this type of proposal, of course, it builds on a lot of work on how to tax the rich and tax progressivity and so on. Here, I guess the main specificity is to draw the lessons from the historical experience with wealth taxation. Many countries have had wealth taxes in the past with various degrees of success, and to try to understand, what has worked well and what has not worked well, and how we could do better in the future. And the type of proposals that are discussed today are very different, in fact, than the historical experience with wealth taxation. In European countries, wealth taxes used to start at around 1 million euros in wealth. Today, the debate is really about the ultra-wealthy, about having taxes for people who have more than $100 million or euros in wealth, so obviously a much smaller population. It's really about ensuring that those extremely wealthy individuals pay taxes if they don't pay taxes today. So these are minimum taxes, meaning if you already pay, for whatever reason, a lot of income tax, you wouldn't have any extra tax to pay. Very different than past wealth taxes. And so on day two, we will learn and we will hear about people, the G20 work on these issues and the international agenda and what's coming next. And we will learn about what's going on in France in the morning and the prospects for such a minimum tax on the ultra wealthy in France. Okay, let me just conclude by most importantly thanking the many people and organizations that have made these 2 days possible. Special thanks, most importantly, to our wonderful colleague Mathilde Auburtin, who from the EU Tax Observatory, who has done such phenomenal work organizing this conference. Thanks a million, Mathilde, our event officer at the EU Tax Observatory. Thanks to the many colleagues and students from the Stone Center, from the EU Tax Observatory, from the World Inequality Lab, and from the Institut des Politiques Publiques, who have accepted to present papers, to chair sessions, and help assemble the program. Thanks, of course, to the many speakers. Thanks to École Normale Supérieure for hosting us here. And most importantly, thanks to all of you for being part of it. So without further ado, let me pass the mic to our Master of Ceremony, Quentin and Alice. Thank you so much and have a great conference.
Hello, everyone. My name is Alice Fauvel. I'm Communications Manager at the World Inequality Lab. Okay. And you are?
And my name is Quentin Parinello. I'm the Policy Director of the EU Tax Observatory. We're not going to be very long here, just to say that we're the Masters of Ceremony, so just ensuring that the flow of sessions work properly. And without further ado, let me introduce the moderator of the first session, Laure Heidmann, from EU Tax Observatory. Laure, if you can please join us on stage and introduce your panelists and what they're going to talk about. Thank you very much.
Thank you, Quentin. So I'm Laure Heidmann. I'm a PhD student at CRES, and I work at the EU Tax Observatory on corporate taxation. And my panelists, can you come on stage with me? Thanks. So it's my pleasure to chair this first session. This morning, we have 4 presentations on 4 European countries. We'll start with you, Laurent Bach. You are going to share your work on income inequality and tax progressivity in France. So you are an associate professor at ESSEC and a firm's program co-director at the Institut des Politiques Publiques. And so you're going to start this panel. Next, we'll have Wouter. So here, Wouter Leenders on Netherlands. So Wouter is a PhD candidate at UC Berkeley. And you're going to present your work on income inequality in the Netherlands before and after distribution. Next, we'll go to Italy with Demetrio Guzzardi here. And you are a postdoctoral researcher at the University of Calabria and an affiliate researcher at Scuola Superiore Sant'Ann. And Demetrio is going to present his work on income distribution and tax progressivity in Italy. And the last presentation of this session will be on the UK with Arun Advani. Arun is a director of the Center for the Analysis of Taxation and associate professor at the University of Warwick. And you're going to present your work on effective tax rate over the distribution in the UK. So the format of this session will have each presentation is 20 minutes. We'll start with Laurent and then Wouter. And then we'll have 20 minutes for questions for both presentations. And then we'll continue with Demetrio and Arun. And then final 20 minutes of questions for these presentations. So thank you. Laurent, floor is yours.
Okay, well, hello everybody. My name is Laurent Bach, as Laura just said, and I'm going to talk today about a research project I have together with Antoine Bozio Arthur Guzzardi and Clément Malguir. And I have to say that this is also a project that more generally is an offshoot from a research evaluation we've made over the years of various tax reforms in France. Although today what we're going to talk is about billionaires and the degree to which they pay taxes in France. It's from a research perspective, it's still very much in progress. The topic in general, and also this project, I have to say, because there have been many measurement tools that people have come up with to try and catch the income of billionaires and to know how much tax is paid on it. But it's fair to say that there is still a debate as which is the best tool and whether there is actually a good way to measure a billionaire income. So there are many different ways you can do it. Obviously, you can run surveys, but people have quickly realized that the response rates to survey is generally low, especially at the top. Then there has been tax data, and tax data has been used a lot since like several decades, including by many people in this room. But the problem is that tax data is reliant on a definition of income which has a lot of holes, especially at the top of a distribution. And indeed, when you use this kind of data, we see in some countries a sharp rise in inequality, such as in the US, but we see a much less pronounced pattern in Europe. And maybe that's the reality, maybe not. And that's why people have come up with other sources of data relying on rather commercial sources of information, such as rich lists that are generated by various generally financial newspapers. In France, that would be the Challenge list, but you obviously know the Forbes list. These rich lists tend to focus on business wealth and business income, but the problem here is that the methodology underlying these rich lists is poorly defined. I mean, it's poorly documented. It's not made by academics, and it's not very clear how these are created. And this poses a specific problem for business income because a lot of business income is concentrated at the top of a distribution. So if you want to know how much income is made at the very top, you want to know how much business income is made. And at the very, very top, a lot of this business income is not declared on personal forms, on forms of personal taxation. And not only that, a lot of this income, even if you could measure it on your own national territory, you would still miss a lot of it because a lot of business income at the very top is not generated in one local country, but in many different countries due to globalization. So in fact, our point here, and I think the general conclusion, is that you cannot solve this without detailed links between corporations and shareholders, and links that go well beyond national registries. And that's essentially what we're going to introduce in this paper and this project, a new database that is effectively linking household records and corporate records using a link between shareholders who control firms and the personal tax forms they fill in. And we are going to do this in the French context. And we're going to do this in one specific year, 2016. We think of this year in France as an interesting setup for various reasons, because France is a relatively large country, so it has a good number of very rich people. And that's important because we're going to focus, as you're going to see, on a very, very thin part of the income distribution. We're going here to think of billionaires as the top 0.0002% of a distribution of comprehensive income. And I'll come back to what comprehensive income means in just now. Essentially, comprehensive income, well, economists have been thinking over about the definition of income over centuries. We are not going to revisit the entire debate today, fortunately. But the important thing is that ideally, you would like to think of income as anything you can consume without becoming poorer. So that's the sum of consumption and the change in net worth, including capital gains. In fact, today, for a number of reasons, we are not going to include capital gains. We are only going to include income that enters capital gains to the extent that this is truly generated in a given year. So let's say that you control a big luxury company. You generate billions of income every year, and you don't distribute it to yourself. That is then retained in a vehicle and increases your capital gains. Effectively, it increases your wealth and it increases your capital gains because the value of your vehicle is increasing due to this income being retained over the years. But importantly, we are not going to include the priced version of this capital gain. We are just going to include this increase in wealth to the extent that it is generated by an actual generation of income. We are not talking today about pure price effects driven by changes in discount rates, changes in interest rates. This is actual money being generated, which we are going to include in our definition. But obviously, the important part here is that we are not just going to include the income that is effectively distributed to the end user of the vehicle, but also the income that he or she has decided to retain in an intermediary vehicle. So, in order to be able to implement such a definition in an actual context, like France, you need to gather lots of different sources of data. So obviously, information on shareholders, detailed shareholder information, hopefully exhaustive. We are going to derive it from various sources of data, but in particular, corporate tax returns in France and many countries have to provide a list of the main shareholders of a given company. We are also going to obviously include personal tax forms, so income and wealth tax returns filed by fiscal residents in France. But as I said, because a lot of this income is retained in vehicles subject to the corporate tax, in order to measure the income retained in these vehicles, you need corporate tax data. And also, because a lot of this corporate income is not retained in France, but elsewhere, especially by the biggest company, you need to have sources of data that allow you to measure how much income is generated outside France. And here we're talking about real companies, real business operations, from which you get a lot of income but retained abroad. In addition to something you might have already seen is that we're also bringing in rich lists in our analysis. So in France, that would be the Challenge rich list, which lists the top 500 biggest business dynasties, and obviously some financial data that is more common. So the final data is about the entire French population in 2016. We are only going to talk here about tax units, so 38 million in 2016. And I'm going to jump directly to the results for the distribution of comprehensive income. So on the left, you have the distribution of personal income as you generally know it, because that would be the distribution of taxable personal income in France, where we rank it per the percentile in the distribution of taxable income, And what you see is that at the very top, the top 75 units, you need to be relatively rich to enter that that part of the distribution. Nevertheless, the mean total income is 27 million euros, and as we are going to see later, that might look like something rather low, especially considering that some business dynasties we know are resident in France and likely generate a higher amount of income in a given year. And precisely that's what we see on the right. So what we see on the right is the distribution of comprehensive income once we add the income that is retained in the vehicles we were able to connect to fiscal residents in France. And here you see that for most of the distribution, there is virtually no difference. For the bottom 99%, there is only a slight increase in the amount of income that is detained if you include the income retained in vehicles. But for the very, very top, essentially, the mean income is multiplied by 10. For the top 75 units, the mean income of the top of the distribution is 10 times higher. And that has an effect in macro terms, because that means that if you use taxable income, you'd think that the top 75 fiscal units own or receive only 0.2% of total income. If you take comprehensive income, you have a result that the top 75 are receiving 1.4% of total income. And generally speaking, we are ending up with mean income that are more in line with what we know about the income generated by the underlying companies. So one feature of this exercise is that it allows us to think about some desirable properties of a good income measure. One of the desirable properties is likely that it is persistent enough, because after all, we are looking at income because we view it as a good measure of welfare, and also because it's generally tied to a number of persistent features of individuals and families, such as talent or the inheritance they receive. So these things don't change very much from year to year, so you shouldn't expect the rank in the distribution to change dramatically from year to year. And yet, if you'd use the taxable income reported in personal tax forms, you'd see that the chances that you are in the top 75 one year when you were in the top 75 the previous year, it was extremely low according to tax forms. And effectively, there's almost 0% chance that if you are in the top 75 filing the personal income tax return this year, you will also filing a big enough tax return next year to be in the same group. It's not at all like this for comprehensive income. You see in the orange line that effectively the chance that you are in the top club next year when you are in the top club this year is effectively very large. So that's a very desirable property. It doesn't mean that there's no mobility. There is mobility, but there is no perfect mobility, which is essentially what you would see with personal income tax forms. So another interesting feature, and that's something new that I'm showing here, one thing we can do with our data is to look at the chance that fiscal unit controls a firm that is registered in a rich list in 2016, in the top 500 business in the firms controlled by the top 500 business dynasties. And when you use personal income tax forms and you look at the top 75, the chance that a top 75 household is in the rich list is less than 15%. If you do the same thing for comprehensive income, you jump to around 90%. So that means that the way we measure income is really the only way to catch individuals and families and dynasties that are controlling firms in those rich lists. So it means it's the ultimate test of the importance of doing this kind of measurement. Another thing that's important to do is to make sure you take the entire income and not just the national income, because you see that if we focus only on domestic income, the chance that you are in the rich list is decreasing slightly. So it's important to not only measure the income retained in French vehicles, but also the income retained abroad. Now, I'm going to go fast on taxation, on the first items of taxation, because we have been talking a lot about it. Like, essentially, because the main source of progressivity in the tax system is personal income taxation, obviously, if you take personal income as a measure of the income distribution, you'd think that the tax system is progressive, because in France, most of the progressivity is coming from personal income taxation. That's what we see here. We do have progressivity using personal income up until very far in the distribution, essentially up until the top 0.1% of the population, and then essentially you have a relatively uniform and high rate of taxation. The picture is obviously very different when you focus on comprehensive income, because effectively the top of a distribution of comprehensive income does not rely at all on income personally distributed. So that means that they don't rely at all on income that is subject to personal taxation. What it is subject to is corporate taxation, that's the pink part, but the rate of corporate taxation is lower than the top marginal rate of personal taxation, and as a result, you have effectively an increase in tax rate up until the top 0.1% of the distribution, and then once you start from the 40,000th fiscal unit, the tax rate is effectively slowly but surely declining from 44% to around 26% in the top 75 units. So I have 2 minutes or so. So essentially, how does this happen? This happens because as you go along the distribution, the usage of intermediary vehicles that allow you to retain earnings rather than distribute them is becoming very, very, very prevalent. Essentially, at the very top, we observe that the main vehicle owned by individuals is not a real commercial company, but it is a holding company. One thing that you might ask is, okay, but maybe at some point this income will be distributed and then subject to taxation. So here what we're showing is the long time series of the income, the personal income you need to declare in order to be part of the top 75. So essentially, this has been around 20 to 30 million euros in 2016 terms for decades. And in fact, if at some point there would have been a day of reckoning of all this comprehensive income that is retained, at some point this blue line should increase. And it never ever increased. And it has increased a little bit in 2017 due to tax reforms, but as you can see, this has nowhere near reached the level of reckoning that it should have been given all this income that has been retained over the last few decades. Now, a big important question is, how do our results from 2016 relate to the stark time series you hear of from the rich list? And here I'm showing the evolution of the top 500 wealth according to the challenge rich list, and you see that essentially since 2010 the total wealth held by the top 500 in France has been multiplied by 5. Since 2016 this has been multiplied by around 2.5. So a big increase in wealth. The question is whether in fact, if we had been able to measure the comprehensive income distribution ever since, would we have seen a similar increase? So, in fact, what we have decided to do so far, because we don't have access to the registry data for 2024 that would allow us to perfectly replicate what we have done for 2016, is to use rich lists, which are reporting a certain amount of wealth, and to essentially use income to wealth ratios for similar industries in similar firms to essentially reobtain the level of underlying comprehensive income that is underlying each of these business dynasties. The important thing is that you see that the amount of income, according to this methodology, that you need to have to be part of the top 50 business dynasties is in fact very close to the amount of income you need in terms of our comprehensive income measure, which was 62. You needed 62 million in comprehensive income to be part of a top 75. The same year, you needed 55 as a business dynasty to be part of the top 50 business families. And then, given that in 2016 is pretty similar, what we see is that effectively there has been, since 2016, a slight increase in the amount of money your dynasty needs to earn in order to be part of your club. It went from 55 to 84 in 2023. So that's a substantial increase, not nearly as much as the increase in wealth that is documented, but still a substantial increase. So that's effectively suggesting that it would be important to update the numbers based on tax data, but already we can say that yes, there has been an increase in the amount of income, even taking into account the effect of inflation, in order to reach the very top of the distribution. One last thing that I want to say is that there have been other approaches used in order to impute the retained income based on distributions of income in personal tax forms. This is what has been done in a lot of papers in other countries using the DINA approach. The problem is that what we're effectively showing here is that the distribution of dividend for a given amount of income is a decreasing function of the level of comprehensive income. So as a result, you vastly underestimate the amount of income that is held by the very top of the distribution. That's what we show here, essentially using, if we had used with our data the DINA approach, at the very, very top, the amount of comprehensive income imputed would be 80% lower. And importantly, if we had used the same approach to measure tax rate, we would effectively not be able to show the regressivity at the very top. So it means that it's very, very, very important to have proper data. You get very different results, very different interpretations based on these corporate links rather than the typical dividend imputation approach. So I will stop here because I think I've been largely over time. Thank you very much for giving me the time to deliver these new results today.
Thank you so much, Laurent. We go directly to your presentation, Wouter, on the Netherlands.
All right. Great. Hello. I'm very excited to talk about our research in the Netherlands. This is a project together with Arjen Bruil from Statistics Netherlands, Celine Van Essen, Arjen Lejour, and Jan Mulman of CPB, and Simon, who's also here from INED. And in our project, we look at inequality in the Netherlands, both before and after the effects of taxation and government spending. But before I talk about our own research, I want to briefly talk about the origins of this research agenda. And those origins are in the late 1930s during Franklin Delano Roosevelt's second term in office, when after a speech that he gave on monopolies and the sort of concentration of economic power, Congress instituted a committee to study exactly that concentration of economic power and concentration of financial control of large corporations and wealthy individuals. And this committee covered topics as wide-ranging as antitrust, agricultural policy, unions, but an important part was also the study of the distribution of the tax burden. And in a panel that consists only of male economists, it's good to remember that the first study of this kind was actually done by a female economist who was working at the Department of Commerce at the time, Helen Tarasov. She was born in 1915 in Toronto, Canada, but grew up in the United States and even spent a year in Paris in the early 1930s as a student at Sciences Po. But in the late 1930s and early 40s, she's working as an economist at the Department of Commerce and worked on these reports on the distribution of the tax burden. So she publishes 2 reports on the question who pays the taxes, and is the first one to really look at the overall tax burden that's faced by different income groups in the US. And the graphs that you'll see in this report are very similar to a lot of the graphs we'll see today, where she shows for different income groups the effective tax rate that they face if you take into account all taxes. For some reason, she plots it upside down. So it's the top boxes that are the taxes. She finds, which is not too different from today's tax system, that state and local taxes are basically flat or a little bit regressive, and the only elements of progressivity in the US tax system come from federal taxes. So fast forward 80 years, the sort of successors of Helen Tarasov published these papers that studied inequality in the US and France in a very detailed manner, introducing a new methodology called distributional national accounts. And what they essentially try to do with this methodology is to bridge the gap that exists between the analyses of the macroeconomy, so of GDP growth and inflation, and the analyses of inequalities, so when we talk about top income shares and bottom income shares. And a crucial part of this is that the income concept at the individual level is the same as national income at the macro level. And this is particularly important, as we'll see, for those at the top, for billionaires, for whom most of the income consists of corporate profits that is often not distributed in the form of dividends. So we really need an income concept that captures that type of income if we want to study those at the very top. We look at this question in the Netherlands in our paper, and basically we're trying to answer the same question that Helen Tarasov asked in 1941, which is who pays the taxes? So as I said, it's very important to realize that the bulk of income for the very rich does not appear on personal tax returns in the form of wages or dividend income. And this is partly because most profits, even of the most profitable companies, are not distributed in the form of dividends, but they are retained within the firm. So if we think of a company like Alphabet or Amazon, these are some of the most profitable companies in the world and have never paid out dividends as of yet. So even if these firms were to pay out dividends, the way that a lot of shareholders have organized their sort of economic income is that these dividends would be paid out to holding companies, and in that way would still avoid the personal income tax. So if we want to study the very rich, we need to go beyond personal tax returns, and we need to also consider corporate tax returns to know how high the profits are of companies and to know how much they pay in taxes. But we also need an ownership registry, a registry of shareholders, link those companies to individuals. And that's what we do in the Netherlands, and ultimately that gives us a data set that contains for every member of the Dutch population a variable that is personal income, a variable that is corporate income, as well as personal taxes and corporate taxes. And just to spend a bit more time on this ownership registry, what it means in practice is that we have information on all shareholdings that are larger than 5% of an ownership in a company. There are about 500,000 individuals in the Netherlands that appear in this registry in a given year, compared to an overall population of about 17 million at the time. And a very simple ownership structure would be the one here on this slide, which is just one individual who owns a 50% share in firm A. And what we would do is we would take the profits that are retained within firm A and assign 50% of those to shareholder one. And if this person owns a 33% share in another company, we would assign 33% of firm B's retained profits to shareholder one. And we would do the same to shareholder 2 and 3 if they also own shares in firm B. Now, we might find out that actually firm B owns 50% of firm A, which means that we also need to assign the remaining 50% of firm A's profits and taxes that are not paid out to firm B and then to shareholder 1, 2, and 3. This is quite a simple structure, but in general, there are a lot more complex and a lot longer structures in our data set. I think the longest that we found and sort of try to unravel is over 20 steps. And sometimes you have like loops, which are also quite difficult to deal with. But we apply the same principle that to the extent that firms retain profits, we assign those to the shareholders and ultimately to the actual individuals that own those companies. And if we do that, we are able to study the composition of income for different income groups. So what I show here on the x-axis are people ranked by their income. So we can see P90 to 99, that's those individuals with an income between the 90th and 99th percentile of the income distribution. And we zoom in all the way to what is roughly similar to the number of billionaires in the Netherlands, which is the 0.0001% of individuals. And what we see is that for the bottom 90%, basically all of these groups get most of their income from labor and pension income. But within the top 1%, the picture looks quite different. So for these groups, the dominant form of income is actually those profits that are retained within corporations, which shows again that if we want to think about the incomes and the taxes paid by billionaires, we cannot ignore these retained profits. And if you just rely on personal tax returns, you're essentially ignoring most of the income of billionaires. And then finally, we can try to answer the question that Helen Tarasov asked: who pays the taxes? And again, we group people in different groups of the income distribution, and we count all the taxes that they pay, both consumption taxes, payroll taxes, corporate taxes, and taxes on personal income and wealth. And what we see is that for the bottom 90% of earners, this is basically one big flat tax. They pay about 45% of their income in the form of taxes. The composition differs somewhat, so we see the personal income tax actually increases up to a point. But what we also see is that for the top 1% of earners, the tax rate is very different. It's around 20%, which is the lowest of any group that we've been able to study. And you might think that the Netherlands is exceptional in this respect, because the Netherlands, you might have heard, it's sort of a tax haven, so you might not be too surprised that the rich in the Netherlands also pay very low tax rates. But we've used some of the studies of other people in this panel, and we've compared our results to theirs, and basically what I think we found is a common pattern among rich countries where there's a tax rate that's quite high for most of the population, and that collapses when you go to the top 10 or top 1% of earners. And I think it's instructive to dig a bit deeper into this by looking at different types of taxes. So consumption taxes, that's for most European countries, that's the VAT, which is most important. For the US, it's the sales tax, and in the future, maybe a lot of tariffs. But what's important about this is that if you look at who pays these taxes, it's actually one of the most regressive taxes. So it's mostly those at the bottom that face the highest tax burdens for consumption taxes. And the reason is that consumption taxes, or like those groups at the bottom, they also spend most of their income in the form of consumption. Whereas at the top, there's a lot of saving and a lot of accumulation of wealth that is not spent on goods that are taxed with a VAT or other consumption taxes. Payroll taxes also tend to display quite a regressive profile, and this has two reasons. First of all, the payroll taxes tend to be calculated as a fixed percentage of labor income, which explains the sort of flat profile for the bottom 90%. And the second factor is that because it's calculated on labor income and not on capital income or corporate profits, those with very little labor income, which are the groups at the top of the income distribution, they pay very little in payroll taxes. So the remaining two taxes are the corporate income tax and taxes on personal income and wealth. And what we see is that taxes on personal income and wealth, which is mostly the income tax, is actually quite progressive for the the bottom 90% of earners. But what we also see is that in all countries, this like the personal income tax really fails to tax the super rich or billionaires. In many countries, this percentage goes down to essentially zero. And the only tax that they do pay is the corporate income tax. So we see that of all taxes, the one that is most progressive in the sense that those at the very top pay it's the corporate income tax. And the strength of this tax is that it does not depend on whether a firm pays out dividends or not. It's calculated as a percentage of your profits. So if a firm is profitable, it should pay some corporate income tax. There are weaknesses too. Of course, we know that large corporations might engage in profit shifting, which would really undermine the taxation of the very rich. So let me conclude by saying that I think we live in a very exciting period for research on billionaires and the super rich, because, I mean, on the one hand, we have access to data on personal ownership of corporations that allow us to study this group in a way more precise than ever before. We're also reminded every day by the news that this is a topic that is relevant and important. And what we've learned from our studies and other studies is that consumption taxes and payroll taxes really play no role of importance for the taxation of the very rich. Even the personal income tax in its current form is not effective in taxing these groups, and it's only the corporate income tax that really bites for these for those at the very top, but not in a way that's sufficient to restore the overall progressivity of the tax system. So there are two natural directions to think about when you want to think about taxing billionaires. One would be to fix the personal income tax. You could have a minimum tax on the very wealthy, as is proposed here in France. You might also want to think about regulating holding companies or the use of holding companies to a greater extent. And the second direction would be to strengthen the corporate income tax. And there have been a lot of international efforts to do exactly this. The US, of course, has recently sort of turned its back on these international efforts, but at the same time, they also remind us of its importance. So I think there are a lot of papers that speak to that in this session and other sessions. So I think we'll be very excited to hear about that. So, thank you.
Thank you so much, Wouter. So now we have 20 minutes for questions from the room. So feel free to raise your hands if you want. If you have a question for Laurent and Wouter. So we have mics.
I just wanted to, morning, great presentations, Superiore from the International Monetary Fund. Lovely listening to all this. Just wanted to find out from you, voters, that these the CIT rates that you calculated, they are actual rates or they're imputed rates? Are they actually what is paid up on the returns, or are they imputed rates from the calculations?
So for the most part, we use corporate tax returns. So they are actual rates. And then there's I think what Laurent mentioned is that to some extent, the taxes at the very top are actually not the Dutch corporate income tax, but it would be Dutch billionaires whose companies pay corporate taxes in France and Germany and other countries. So for the part that is non-Dutch, we have to make some assumptions, but for all Dutch companies, we can see how much these corporations actually pay in corporate income tax.
Thank you. Thank
you. My name is Ricardo Guerrero from UNDP, and well, thank you for your presentations. I want to ask something to Laurent in terms of your presentation. You were showing a very interesting graph on the mean income at the end of the presentation. And there's a peak into 2021 until 2023. That kind of speaks a little on the fiscal influx that we had during COVID. I was wondering whether that can be the situation, and also how these transfers of wealth from the fiscal influx can also be related to the effective tax rates that were paying by these individuals or not, whether this increased the effective tax rate during these years, or the effective tax rates remained barely similar compared to the previous years. I don't know if you observed that trend when analyzing this data. Thank you.
Well, thanks a lot for your question. So what you see in this graph in the period post-2016 is effectively what you see if you look at the accounts of French listed companies. So that's effectively what this reflects. So the valuations have gone up very significantly. So you have a multiplication of valuations of assets since 2016, of listed assets, by about 2.5. But in fact, the income to wealth ratio during that period stayed constant. So what that means is essentially that the rise in market values that you've had in French listed firms since 2016 is effectively reflecting an increase in pre-tax income generated by those companies. Now the question is, where does that come from? As you rightly point out, there has been a decline in the COVID year, and then there has been a huge rebound in 2021. So many of these companies are international, so I cannot speak to all the different schemes that they have been exposed to. What we can see is that there has been a very sharp rebound in 2021, a slight decline since 2021, but we are still at levels that are much, much higher than what we would see pre-COVID, and even after adjusting for inflation. So it's to be honest, this is what the data says, and I cannot really tell whether this is coming from the COVID schemes and the resulting taxation following this. I'm not able to tell you rightly at this stage. What I can say is that using the same data, if you look at the evolution of a corporate tax rate of these companies, it has declined a bit in the long run. So it was slightly above 30% in listed accounts before COVID, and it's more between 25 and 30 according to these accounts. So there has been a slight decline in the long run. Obviously, if you look over decades, there has been a much steeper decline according to listed companies' accounts in the corporate tax rates. So this is the big trend. What happened around 2021, I can't really tell exactly.
Hello. Thank you for the presentations. My name is Alana Markle from Open Ownership. I was wondering if you would find value in integrating data particularly from beneficial ownership registries in addition to shareholder registries and other types of asset registries, if that was more comprehensively available, or if you feel that shareholder registers are covering the vast majority of ownership and control relationships that would be relevant for this kind of analysis. Thank you.
Yeah, I think, for example, in the Netherlands, in the year that we study, these UBO registries were not yet fully in place. But in the most recent years, like post 2022, these are actually used by the Statistics Office to improve their ownership registries. So I think they are very much complements, and there are some limitations, especially related to the sort of threshold that you'd only need to report ownerships above 25% and similar rules. But in general, I think they can be used to improve these registries.
Can I add a compliment? I think it's a great idea. Theoretically, these registries are great. In practice, it's a different story. Why? I just did an exercise recently, is take the 500 rich list and look at what is declared in those registries. I think journalists are doing a much better job at finding out the ultimate beneficiaries than these registries are currently doing. So in fact, it's a great idea, but we need to think about who is declaring and how to use this information correctly, because for now, it's dominated by commercial sources in order to trace the ultimate beneficiaries of the biggest companies. At least I cannot speak to the Dutch context, but clearly in France, it's supposed to be compulsory, and it is, but the way it is declared and filled in is not as good as what the journalists would be able to uncover by simply looking at the latest bit of financial press.
Hello, my name's Andy Summers from Centre for Analysis of Taxation and LSE. Thanks for a really, really fascinating couple of presentations and really important step forwards in the measurement of these top groups. I wanted to ask a little bit about capital gains. So, I mean, I understood your point about the difficulties with pure price effects and discount rates. And obviously the further challenge that if you're measuring retained profits, you'd potentially be double counting realized gains. But I guess just going back onto your puzzle about how this income never seems to show up over the long run, I assume that is because in the end these are capital gains which are either relieved at death or perhaps when people leave the country not fully taxed. So from a policy perspective, one of the I think sort of policy options that Wouter didn't mention briefly in the list is if we were able to tighten up the current leaks in the capital gains tax base, then how far do you think that would go to addressing this problem?
Well, I think you're right in the sense that indeed, if we plug like these leaks here and there, and in particular the stepped-up basis, I think that theoretically, if governments were super consistent in their path of taxation policy, which I think is a very unrealistic assumption, that would probably make it very difficult to avoid eventually paying tax on these retained earnings. The practice is that even if you have the best, the most organized taxation system with no stepped-up basis, no capital gains tax relief, it only takes a slight change in government, and these are mostly democracies these days. And even dictatorships have changing tax policies. If you're in a scenario where you have no possibility of commitment, it gives a lot of optionality to optimizing households. And that raises a big ultimate limit to the amount of leaks you can plug by eventually saying that these will be taxed. And it's important to keep in mind.
Hi. My name is Benjamin. I'm from the Belgian Workers' Party, and I had a similar question to the ultimate beneficiary owners registry. And it was more about you personally in your research. So you had to then rely directly on the data on the registry in the Netherlands. And a very simple question is, how easy was to access it? Because in our country, in Belgium, for example, they have restricted the access by applying very strictly a ruling of the Court of Justice. So I'm wondering what's the situation like in the Netherlands. To my recollection, Belgium is quite an exception in the restriction. There are a few others. Granted, of course, the flaws of the system, but there's an added issue there. I was just wondering if
So the data that we accessed they're all maintained by the Statistics Office. So in that sense, it's a very formal process where you apply or you apply to get access to these data, and you need to pay the cost of accessing this data. But in principle, that's possible. I think one issue, especially if you're studying groups of like billionaires in countries like the Netherlands is like still has a good number of billionaires, but usually with this type of administrative data, you do have rules that you cannot, publish results that cover fewer than a certain number of people, and those can actually start to be important if you study a very small group. So I'd say the like statistics officers can learn from each other in how this access to administrative data is organized, but there are these limitations even in the best organized countries. Yeah.
No more questions from the audience? Okay.
So I would just be curious about what exactly drives this pattern in the first presentation of the sort of falling importance of dividends in very ultra high net worth individuals, right? So the point that you made about the DINA imputation sort of failing there, is that, so yeah, I was just wondering what's the mechanism behind it. Is that those people are having holding companies that cash in these dividends, or?
Yes, so in the personal tax forms, the dividends that are recorded are not the dividends distributed by the underlying commercial activity. It's the dividends received by the controlling individual. And in between, you have these holding companies that are essentially entirely disconnecting the patterns of dividend distributions by real activities and the patterns of dividend reception by the real individuals who control these companies. And effectively, when you control the dividend distribution, you will distribute the dividend only when you absolutely need it for consumption purposes. And there's a rule in economics that works pretty well, is that the propensity to consume is a declining function of income. And this is effectively what is going on here. So the rate of reception of total income in the form of dividend is effectively declining because the propensity to consume is declining with income.
So essentially, this would show up as like retained earnings in these holding companies up to the point that these individuals decide to consume it.
Yeah, exactly.
Okay. Okay, thank you.
Do we have more questions, or we continue the panel with no more questions? Okay. So Demetrio is going to present income inequality in Italy, then Arun, and then we have time for questions at the end.
Thank you. How do I... Okay. Yeah. So, hello everyone. Thank you for inviting me. It's an honor for me to be here and present the work that we have been doing with colleagues in Pisa at the Scuola Superiore Sant'Ann. So let me start with some of the motivation that brought us to this kind of research. So we started to see that there was an increasing trend also in the literature that finding increasing inequality in many advanced countries. And so we also thought, okay, what is going on in Italy? And also, especially, we thought, but a good taxation system should keep in check inequality. I mean, even if redistributive policies do not work, at least with a good tax system, we should be doing well. But the problem was that already some results were emerging from other countries. There was the work on the US tax system that was cited before. That was finding a regressive tax system for the US. And in the period that we started to work, there was also the result on France, and during the same period also the work on Netherlands that we saw before. So we said, okay, so what's the trend of inequality in Italy if we follow the methodology that was used also in other countries, like the distribution national account? And about the tax system, is it actually progressive? It is regressive, like it was for other countries? Is it at the best level? Can we also say something on what the best level of taxation we can have in Italy? So what we did in the first work that we managed to publish last year, and that we together with Elisa Palagi, Andrea Roventini, Alessandro Santoro. So we applied the distribution national account methodology. We recollected all the national income at Italian level, and we distributed at the personal level in Italy. On top of that, we just do not focus on income, but we also try to reconstruct how all taxes are distributed in Italy. So we also account for all the direct taxes, which are personal income taxes, other taxes on financial income, on corporates, and also indirect taxes like VAT taxes, all the other taxes on consumption, etc. And having both of these things, we estimated was the effective tax rate paid by Italian tax payers. And we show it then also how it looks like when you distribute individual based on income or when you distribute it based on their net worth. What are our main findings? So we saw that there is an increasing trend of income inequality. Is also a little bit higher than was estimated in previous studies.
we saw that the poorest individuals are the ones that are affected the most by the crisis. We found also that among this group, young individuals and women especially also are hit the most by inequality. And regarding taxes, we saw that the tax system is slightly flat, maybe a little bit progressive at the beginning, but then it starts to begin regressive when you look at the richest 5% of the income distribution. And this is mainly to indirect taxes on consumption, on financial income, and a little bit also on social security contribution. But we'll talk about that later. And so we also said, we started to think on how can we fix this tax system, and we saw that probably having a better taxation also on capital income would help reducing inequality and increasing fairness of the tax system in general. Some details. So unfortunately in Italy, microdata on administrative data are not available even for researchers. To my best of my knowledge, they have never been used and never anyone has been allowed to use it. So we had to combine different data sources to overcome the limitation of each database. We started with the IT Silk, which is the portion of Italy for the EU Silk. We adjusted sample weights just to account for better accounting for the top of the income distribution using the tabulations of personal income tax tabulation at regional level. We merged this dataset with the SHIV, which is another dataset made by the Bank of Italy, which has information on wealth. So doing this thing of merging the two datasets, we have a joint distribution of income and wealth and income and consumption. But then we adjusted distribution of wealth using the work of Acciario Alvaredo and Morelli, which is also the distribution of wealth account that have been used on the WID dataset. And then we also adjust the consumption part using data from the HBS, which is more precise on the type of consumption that people do, because we wanted to better accounting for different VAT taxes that people can pay according to a different type of goods and services that they consume. Then we do the match with the national account, so to also adjust for tax evasion, but also we borrow the gradient on the evasion, taking the work from Albarea and co-authors. So what happened? What we found? We show some. I show here the comparison with France and US. What we found is that if you look at the top, Italy is very close in level with France. So we say it is similar to the EU, to other EU countries. But what I think is interesting is that the trend that we see for Italy, especially when you look at the top 0.01%, is much more similar to the one that you observe for the US, where there is an increase after the financial crisis for them. But when you go at the bottom distribution, things start to change a little bit. We see that the middle 40% has an increasing trend in income share, even faster than France. But the problem is that the bottom 50% is as a lower level than France, and is also decreasing its income share faster than the US, which is somewhat worrying. So using this data set, you can also track how the distribution of increase or decrease in national income is distributed across the population. Regarding Italy, we saw that during the period that we analyzed, we have in general a decrease in real income of about 15%, but not everyone has experienced the same loss of real income, of course. And this is what we found. So the top one, everybody has lost income, but not at the same level. Okay, so we have the top 1% who decrease a little bit, then we have top 10, middle 40%, and then a huge reduction by the bottom 50%. Let me go to the part on taxation. So we calculated this effective tax rate. We have information at the macro level of a lot of different taxes. So we have information on 25 categories of direct taxes. We have 66 categories of what are defined as indirect taxes. By grouping them, we group them according to the type of income they are paid or the type of taxes they are. And this is what we found in general overall in the country. We see that we have an average tax rate, macroeconomic, of 46.3%. And it is in general, at the bottom of the distribution is a flat tax rate. It starts to increase at the middle of the distribution, but then it starts to decrease again at for the top 5%. And this is due, as was saying before, indirect taxes on consumption are relatively regressive, are always regressive. Social security contribution also play a role, is becoming regressive at the top. But the point here is that labor income at the very top is decreasing, So people, which is the only progressive tax that we have in Italy, basically. So people are earning more on financial income, or as was saying before in another presentation, this is just the focus on the top. You see a lot more on corporate income. So this is why corporate taxes are more important at the top, and labor income and progressive income taxes are less important. So this is what we found at the overall when we look at the distribution of income. But we also thought, okay, let's rank individuals by their net wealth distribution. And in that case, you see that the tax rate is completely regressive, always. So after that, we started to think on, okay, what are the possible, what things can be done to adjust this situation in Italy? And we started to work on another paper that we still didn't publish. It's still a working paper of the Working Inequality Lab. And it go mainly in two directions. We wanted to use the new distributional wealth account that was done by the European Central Bank last year, which has more information on the part on the categories of wealth that people have according to their percentile. And also we wanted to try to see what's the result of some fiscal reform that could be done, also using optimal taxation or theory, or just trying different hypothetical tax rates. So we did something new. We take this the data on distributional wealth account from the European Central Bank, in this case given by the Bank of Italy, where they have information on wealth consumption, on wealth groups by percentile. And this is what we find, that at the very top, they have much more in wealth that is related to investments, listed share, financial income, non-financial income. Housing is much more at the bottom or in the center. And this influence the overall distribution of capital income, which we try to update it. And what we found is that when you distribute the income according to this better measure, probably type of wealth, we found that the rate of return of people are increasing with their net wealth distribution. So it is a little bit lower at the bottom of the distribution, is increasing slightly over the distribution of wealth, and then is increasing when you go at the top, becoming very important at the top 1%, and the top 0.1%. And this influenced only slightly actually our results, and especially on the tax rate. We just moved. We shifted a little bit. The regressivity doesn't start at the top 5% now, and it starts a little bit earlier at the top 7%. And this is because we are giving, in this way, we're giving a bit more of capital income at the very top of the income distribution. So we tried some, we decided to try some possible fiscal measures. So the first one, the red one, is just what will be the effective tax rate if the regressivity wouldn't start. So you're just going straight from the top 10%. And the other two cases, we estimated an optimal taxation level using optimal taxation theory from the work of Sais and Stancheva. And we tried three different things. So the green one is a comprehensive case. So we say, we thought, okay, all the type of incomes, regardless whether it is capital income or labor income, is taxed in the same way. What would be the optimal level? We found that there is an increasing trend and should be slowly increasing up to about 60% for the top 0.1%. And then we also thought, okay, but in Italy, the tax system is not comprehensive. We tax labor in a way, capital in another way. So let's keep it the same thing. Let's apply optimal tax rate for labor and for capital. And what we found is what we called it optimal scalar tax rate in purple. As it would increase even faster, but still going around about 60%. And the other case was, okay, but what about, let's assume people don't want to tax differently labor. Let's keep it as it is, just want to tax capital differently. What will happen? What will tell us the theory? And you see in orange, it was still increasing a bit more on the very top of the income distribution, but would still reach about 60%. And we tried with different elasticities values just to account for behavioral responses that people could have, having different type of declaring less after this reform. And in any way, we found that the change in public revenue will be positive. In any of this direction, policy would want to go and will still have a positive effect on public revenue, will be also a reduction in inequality, a bit more on progressivity as well. Here, these are the values of elasticity that we tried, but we also tried with different higher or lower to see what will be the effect. Then we said, okay, but maybe, again, you don't want to change the system with an income taxes, different income taxes. You just, maybe you want to fill the gap to avoid the regressivity of the tax system. What would be the equivalent wealth tax that will be needed to reach that level of effective tax rate that we saw before? And this is what we found. So there will be at the beginning, of course, there will be a lower level of wealth tax. It will be about 0.3% when you for the top 7%, and then increasingly and will arrive to 1.3, 0.5, 1.4% at the top 0.1 of the income distribution. Again, this might be, we wanted to try different things and also see what will happen in terms of tax revenues. And so we said, we thought, okay, maybe we can also just focus on the very top as the international debate is going. What will be the tax revenue if we apply the 1.3% wealth tax on the top 1% of the wealth distribution in Italy? What will be the effect in revenues? This will be about 30 billions we accounted for. We also accounted here for different elasticity values to account for behavioral responses. We tried also on the top 0.1%, also just on billionaires, using data from Forbes that we have from 2022, which is about 50 individuals, which is like before 0.0001%. And we also said, okay, maybe you want to increase it a little bit for the billionaires, so just arriving at 2% as it was for the G20 proposal. And we found this accounting for some behavioral responses, it will be about 3-point-something billion for the billionaires. So yeah, just let me conclude on this. Yeah, so what we did in this work, we estimated this new income distribution in Italy using the distribution national account methodology. We found that there is a higher concentration than previous studies show for the top 1 or top 0.1%. We found that the bottom 50% are the one who lost the most during the crisis that we had in Italy. We didn't show it here, but we saw that between this bottom 50%, the youngest individuals are the ones who are hit the most. And in terms of gender that we also have in the paper, it's we found that gender gaps are present throughout the whole income distribution, not just at the bottom, but is increasing, and it is also going very much high at the top 0.1%. About the tax system, we found this the tax system is regressive for the 5%, for the richest 5%, and we also, in the paper, we also divided people according to the main source of income. We see that pensioners are more subject to a progressive tax in total. So their tax rate is more progressive than the other. Employees are slightly progressive only. Self-employed workers mainly flat. And capital income earners are the ones who benefit the most from regressive tax system, which is a beginning regressive and then become flat at the top. But in all these cases, anyway, we see that there is a reduction at the very top of the income distribution. When we consider the wealth distribution, the effective tax rate become always regressive, and we see that with these optimal taxation models, we should point towards an effective tax rate of 60% when you look at the very top of the wealth distribution. So this measure, we see that they would increase tax progressivity, reduce inequality, but also would increase tax revenue, which is much needed thing. And this can also be done the same using a wealth tax instead of an income tax. So, and just last 2 points that I want to make on the policy discussion that we're having. So also thanks to the work that have been done here, also at the international level. Also in Italy, we're moving. The public debate is moving a little bit on this direction of talking about wealth taxes, for example, with Oxfam. We contributed to the preparation of a manifesto of tax the rich, which also was in line with the EU proposal that was done also at EU level by Thomas Piketty. And in Italy was signed by 130 economists. We were proposing several different type of reforms for a more equitable tax system, and one of these was also the wealth tax. And at EU level, unfortunately, now the discussion is moving a lot towards taxing more people because of rearm policies. And sometimes it's also said, you know, we want to tax people, the richer, because you are envy or something like this. The problem is that, you know, you have a climate crisis that we should address, and been studied that this kind of fiscal policies, if applied at EU level, so just be more comprehensive, targeting better the top of the income or wealth distribution, could cover adaptation and mitigation costs for the climate crisis. So this is also one thing that should be taken into consideration when having this kind of debate. And yeah, that's it. Thank you for the attention.
Thank you, Arun. Sorry, Demetrio. Now it's time for Arun on the UK.
Great. Thanks very much for having me. I thought, given that I know I'm the last speaker at the end of a long and thought-provoking morning, I would maybe step back a little bit and use the UK as a chance to give you some lessons for taxing wealth and taxing the wealthy, building on some of the same themes we've had already, but bringing in a few other aspects. There's actually evidence from a few different papers. So the background to thinking about this is kind of what Gabriel set out, so it's easy for me to kind of skip most of this, but there's a discussion generally about raising money both because of fiscal challenges and because of some of the political challenges that we're all currently facing. And so that has motivated a lot of the discussion around whether we should tax wealth more in general, and whether that should specifically be the wealth of the wealthiest. And so I thought I'd give you, as I say, a few different lessons from the UK on what has and hasn't worked so far. And that might help us think a bit about where policy should be going. So first, on the question of taxing wealth. So like most countries, the UK has a variety of taxes that somehow relate to wealth, and this will help you understand some of the figures I'll show you in a moment. So we have a tax on dividends, on flow income received by individuals who own assets that kind of give a yield of dividends, and they're taxed at a lower rate than the headline income tax rate. Partly that is a reflection of the fact that there is already corporate tax potentially paid on those. It doesn't necessarily exactly match the corporate tax, given that we know that there are issues around what profit is declared for those purposes. But that's one of the rationales for that lower kind of rate. On the other hand, it's worth saying that there's a payroll tax on top of that, 45% income tax. So this is just the income tax rates that I'm comparing, not adding payroll just yet. We have capital gains tax. Capital gains taxes are charged on realized capital gains. So when I dispose of an asset that I acquired at some lower value, that increase in value is taxed, and that increase in value is taxed at a rate that is lower than income tax rates. So it's currently, as of 2 days ago, taxed at 24%. Before that, for a long time, it's been 20%, but it moves around a little bit. It's, for a long time, since 1998, been consistently lower than income tax rates. And there are also some very large reliefs, specifically in capital gains tax. And so historically, in the period that the data here is from, you could get quite a large amount of capital gains at a 10% tax rate. So those are taxes on receipts from wealth. There are also taxes on transfers of wealth. So in the UK, we have a tax on the transfer at death. There's an inheritance tax that's taxed on the estate of the individual who's dying. And in principle, there's a very high rate. There's a 40% rate on everything above about £500,000. So that captures only a relatively small share of estates. You know, about 6% of deaths leads to inheritance tax paid. But in principle, quite a high tax rate. So those are all the taxes you need to know about to understand what I'll show you now. So here what we're doing is none of the difficult, complicated things that other people have done much better than I've done, where they're matching in to get retained earnings to try to use corporate registries and so on. This is just taking the personal tax registers for individuals in the administrative data, taking everybody in the UK, and we're just ranking people here by income in millions, in pounds terms, so it's nice and easy to understand. And the grey line at the top is showing you what you would expect the what you'd expect the tax rate to be if everybody had all of their income from earnings and were paying, therefore, the headline rate, and there were no reliefs. So that's what you should expect the curve to look like in a world with no reliefs, in a world with no income from other sources. The bluish line is showing you the effective tax rate on income constructed by just taking all of the income tax that's paid and dividing it by all of the income. So there's all kinds of things you might also want to include, as we've been hearing about other things that should go in an income measure. But that at a very basic level is what the current tax rates look like. I'll tell you why it's important and why it's still useful to look at this. The red line is taking all income and all realized capital gains. So not accrued gains as they come, not retained earnings until they're realized, but at the point that somebody is kind of making a realization to actually get hold of those assets. And we can argue about whether people get benefits from the assets while they haven't realized, but at the point they're realized, they certainly have the ability to use them. And you see the effective tax rate is even lower. So these are just averages at different points of the level of income or remuneration, which is income plus realized gains. These are just the average, effective average tax rates. We could instead say, well, there's a lot of people at any given point here at £1 million, at £4 million. There's lots of people under this. So actually, is this everybody? Is this varying? So here what we're doing, this is a bit complicated. So let me walk you through it. So he's just taking that remuneration red line, the one you saw a moment ago, income plus realized gains. That's the same red line you see here. That's the average of all of the people at any given point of the remuneration distribution. So you could look at, say, £2 million, and you can see exactly that red line is the average of all of the people at £2 million. But some of them will be paying more, some will be paying less. So take all the people at 2 million and rank them by, within that 2 million bucket, by how much tax they actually paid, income tax and capital gains, divided by all the income and gains that they realized, and look at what that share is. You can see that about a quarter of people are actually at that level paying the 45% rate. They're paying effectively all of their income and gains is income from earnings, and they're being taxed fully at that rate. They're paying the rate you'd sort of expect them to pay. Another quarter of people, nearly, are down at a 10% rate, so paying substantially lower than the kind of headline rate. And so this variation is quite important because it's a mistake sometimes to put together all of the wealthy people. I mean, these are much lower levels than the billionaires at this point, but to put them all together in one bucket and say, well, they all do the same thing, they all have the same situation, there is a lot of variation here. That's also important from a policy standpoint, from a kind of political communication standpoint, because when you look at this, I think one lesson you get is it's not just the standard conversation you get from this graph, which is, well, look, those rich people up there are paying much lower rates than these people down at the bottom. You can also make the point, which I think is genuinely important to understand, that at the same level of remuneration, there are people paying quite a lot of tax, and there are people paying much less tax. And so it's not a rich versus poor thing. It is also about people with the same levels of return, of income coming into their pockets, who are paying very different levels of tax. So one more thing I want to tell you about this, and I'll explain to you then why I've done this much simpler thing than what everyone else has done. The final thing I want to show you about this set of results is that when we first did this, I thought, oh, it's tax reliefs. There are all these reliefs in the system. They're all complicated. They're hard to understand. But with all these reliefs in there, this explains why these rates are so low. And so when we first produced these results, we didn't yet have this graph. And so when I talked to people about it, that's kind of the message I was giving people. And then we produced this graph, and I realized reliefs are there, but they're really a tiny part of what's going on. Most of what's driving that much lower effective tax rate is just the fact that statutory rates for some kinds of income and for gains are much lower than headline rates. And so although there is that headline rate on earnings, the actual statutory rate for some very other standardish forms of income or gains are much lower. And it's that compositional effect of where people's incomes are coming from that's driving most of this, not their use of relief. So reliefs are in there. Reliefs also would get more important in a world in which you aligned statutory rates. But at the moment, these gaps in statutory rates are what's driving a lot of what we see here. So why is all of this interesting? Why should you care about all of this when people have just showed you that it's really important when you're looking at top incomes, top wealth, to think about much more complicated things around retained earnings and how they change over time? I think because there are policy lessons you could draw about retained earnings and how we should think about those and what we might want to do. If you want those policy lessons to happen, if you want someone to do something with them, you have to go and convince some politicians to make reforms and convince the public those reforms are necessary. These are things that people are actually getting in their pockets right now, right? This is money people actually have right now, and we're not currently taxing it in a way that's consistent across the distribution. So this should be the easier challenge to solve, and it's important to recognize that even with the easier challenge to solve, we have these big gaps. And so if we haven't solved these, we should be aware that anything else we're going to try and do is going to come up against an even bigger challenge than whatever political problems this is coming up against. So I think it is important to recognize that even among the income and gains that people are receiving, there are these huge gaps in actually what the rates look like. Just to show you that that's not just about income and gains, let's switch over to inheritances. I should have said this previous work was co-authored with Andy Summers, my frequent partner in crime, who's down in the front, and Helen Houston. Now switching to a different paper, also with Andy, and with Francesca Disselbacher and James Forrester. This is looking instead at inheritances. Same kind of story. We're going to look at inheritances, and we're going to look at what the effective tax rates are on estates of different sizes. So inheritance tax is paid on the value of wealth that you leave when you die, and we can rank people based on the size of their estate, and then we can look at what the effective rate is by taking the tax actually paid divided by the value of their estate. You should expect it to be 0 at the bottom because there's a threshold at the bottom that says there's nothing to pay until you get to 325, and then for most people there's actually nothing really to pay till 500, but it's a bit variable because there's a special extra 0% rate if you have housing wealth specifically you're passing on. So that's why it's still quite low near the bottom. But that headline line is the one showing you kind of what you would expect the rates to look like if everyone were paying that full headline rate. What you can see is that the orange line is much lower, and the red, so actually focus on the red for a minute. The red line is much lower. That's when you take all estates at any given level of wealth, take all their tax divided by all of their wealth. That's the tax rate. Now, one of the big reasons for that level being lower is that within couples, we don't have any inheritance tax. So if I die and I pass everything to my wife, there's no inheritance tax to pay at that point. The assumption is, well, when she dies, it will get taxed. And so it's quite reasonable to kind of exclude this. And so maybe we don't want to account for the fact that some of that low level is just stuff transferring between spouses. So the orange line is looking only at people who die single, either because they're widowed or because they always were single. And even at that point, you see that their effective rates are much lower. And again, they're regressive at the very top. As before, we can look at how that varies within the wealth distribution at any given point. So here we're showing you 15th percentiles, 75th, 25th, so on. So showing you the range here. And again, at the top, there are people who are paying what looks like that headline rate. But there are also people who are paying much, much lower rates. Here it is about reliefs. It's not about different statutory rates. There is only one statutory rate. It's all reliefs. I have a slide that I didn't include because it's too niche for this audience of all the different reliefs in the inheritance tax system and which ones are the ones driving it. But I figured it's probably not going to be very informative for this audience. I mean, a big part of it is that in the UK, until next April, currently, you can pass on any amount of business wealth entirely tax-free. And so if you own a private business and you pass it on, that's completely 100% tax-free. And that, given that we know that business wealth is important at the top, that's what drives down a lot of that effective rate. But that is supposedly going to change next April. So that's what we learn about taxing wealth. And again, the reason I show these things is because if we haven't solved the problems here, it's worth noting that these should be sort of easier problems to solve, given this is stuff that's already in the system, than creating a new tax. It's not to say we shouldn't create new taxes, but those are some of the things there. But suppose we've looked at those things, we think we can solve them, or we can do something about them. We want to move on to thinking about new taxes. One concern is always, when you try and tax the wealthy, they might move. And that's, we've all heard this. Anyone who spent any time, 5 minutes in policy thinking about tax on wealthy people, you immediately get the response, but people will just leave. So the UK is a great context to study this kind of question because we have a large and actually at baseline, like in the absence of tax changes, fairly mobile population of wealthy people. So it's a great lab to study how mobile these people really are in response to taxes. So the UK, for those who don't know, until recently has had a system where we have a hybrid taxation system. Most countries tax based on residence. The US is an exception. It taxes you based on your citizenship. Most countries tax you based on how much time you spend in the country. You spend long enough there, you're tax resident there. The UK has this hybrid where if you spend long enough there, you're tax resident, but if you declare that your permanent home is not the UK, your domicile is not the UK, then you were, until, again, this weekend, exempted from tax on any foreign income or gains that you had. And so that naturally meant that people who are coming from abroad, coming to the UK, as long as they can maintain a claim that their permanent home wasn't the UK, and there was no kind of formal test for that. But as long as you said, my permanent home is not the UK, you don't have to pay tax on foreign income and gains. And that was a kind of clearly a very large benefit to some people. So this remittance basis, this like ability to not pay tax on this stuff, has been around for a long time, since 1799. Originally introduced in the colonial era as a deferral of taxation, but it sort of turned into a permanent exemption in practice, because it turns out these days that the deferral was you didn't have to pay tax on it until you brought it into the UK. It turns out now you can spend money you have abroad without having to bring it into the UK. And so what was once a deferral, well, to spend the money when I live in the UK, I at some point need to bring my sugar from a plantation over to the UK, became, well, I'll keep my money in an account somewhere else and I'll spend it when I'm abroad. And so that's not really the point of it. And so in 2017, we did a reform that limited this regime, so you could only access it for 15 years. After 15 years, you can still maintain the claim that this is not your permanent home in the UK, but you're now taxable on those foreign returns anyway. And as of this weekend, we've moved that all the way down to 0 for that regime, but we've created a similar regime that lasts for the first 4 years. So new arrivals to the UK as of this weekend have 4 years in which they don't pay tax on foreign income and gains, but now it's a genuine exemption, and it doesn't matter whether you bring it onshore, but for 4 years you have an exemption and then you start paying tax. So the reform we did back in 2017 was a big reform. We removed access to this regime for people, and these were pretty wealthy people. And so you actually see a huge increase in the effective tax rate. These are the actual effective rates. This is not sort of theoretically in principle what do people pay. This is like actually on the ground what happens to the money they're reporting. So average tax rates, you can see between a treatment group of people who are between 15 and 20 years in the UK, so they are affected by the reform, compared to a set of people who are 10 to 14 years. You can see that they're very similar in average tax rates all the way up until 2017. Reform comes in and there's a 15 percentage point jump in the effective tax rate, because these people have a lot of money that suddenly comes into tax. And typically, since most countries tax on residents, with the exception of a bit of withholding taxes you might have had in some places, and with the exception, of course, of the US where there's citizenship taxation, these are people who weren't being taxed on that money anywhere else. They've just suddenly had a very big tax increase. So what happens to migration for these people? There's an increase. Of course there's an increase. I mean, you tax them more, some people are going to respond. But should we think of this as a large increase? We see that for a 15-point jump in their tax rate, you see about a 5-point jump in their immigration rate. And that happens for a short period. And then we go down to actually a lower rate, which is, I think, consistent with what we, from other evidence I'm not going to show you all today, we think about as people bringing forward migration decisions. This is a mobile group. Some of them genuinely do leave as a response to the tax, but some of this leaving that you see in that spike is people who would have migrated at some point in the future, and they're just bringing that migration forward a bit and doing it earlier because now they've got a reason to think about it this year rather than next year. So there is an impact. It's not without some kind of effect, but what we see is that the elasticity is about 0.226. So it's a relatively modest stock elasticity. The reduction in the number of people in the UK in response to this change in retention rate is fairly modest. So it's important because when we think about these kind of Laffer effects and like, will people leave? How costly will it be for the UK? What we find is it's not that many people who are leaving. Again, we have like much more detail than this in the paper, but it's also the case that among those who do leave, they're quite selected. The people who leave are the ones who were least connected to the UK in terms of the labour market or in terms of any other kind of economic connections. So a lot of people who were living in the UK, spending time there, but weren't getting an income from the UK. And so it was least costly for them to leave from their personal perspective. It was also least costly from a fiscal perspective because they're the ones who are actually paying the lowest levels of tax. When you look at the elasticities and how they compare, I mean, standard errors overlap here, but the bottom tercile by UK income are the ones who are most elastic. The ones who actually have the highest levels of tax are actually less at baseline and less likely to move. So that's what you're seeing in that left-hand graph. In that right-hand graph, another thing you want to think about is when people leave, what does leaving mean? For most of us, when we leave, it means, we change from one country that we spend all our time in to another country we spend all our time in. For the relatively wealthy people, they tend to have multiple bases anyway, and they travel around quite a lot. And living in a country still might only mean that they spend 4 or 5 months there, and they spend a few other months in various other homes they have. And so that's kind of consistent with what we see here, where for the set of people who leave the UK in response to the reform, those are the red bars over on that right-hand graph, what you see is an increase, people leave, but most of the people who are leaving, not most, a large share of people who are leaving actually bunch just below the threshold for the number of days you can spend in the UK. So there's a threshold test that says, if you spend more than a certain number of days, you're going to be tax resident in the UK. And you see a lot of people be just under that, within 10% of that threshold. So they're not becoming tax resident, but they're still making the most of the amount of time they can spend in the UK. Whereas the orange bars are people who are the same kind of person, but who was leaving in earlier years before there was any tax reform. So they were leaving just because they were leaving. And so in that group, you see many more of them were actually going down to basically 0 days. They're spending no time in the UK. And so you see there's a big shift in what that distribution looks like. That red distribution is a mix of people who are actually responding to the tax and some people who were actually would have left anyway. And so the true kind of response for the people who are responding to the tax would probably be larger bunching than here. We haven't done a deconvolution to do that. But that tells you that when people respond to taxes by deciding maybe they want to leave, you need to think out, well, who is going to leave and what is the impact on the economy? Both from a fiscal standpoint in terms of work, it looks like the people who are paying the lower levels of tax are the ones who are more likely to leave. But also in terms of how much time do they still spend in the UK, how much time do they still spend going out in London, doing, going to restaurants and going to the theatre. Well, they still seem to spend quite a lot of time in the UK. So they will still be paying some of that money, spending some of that money in the UK. So, to wrap up, 2 kind of main takeaways I wanted you to get from this talk. The first is that wealthy people pay much lower levels of tax than the headline tax rates would suggest. That's partly the impact of lower statutory tax rates. It's partly the fact that there are reliefs that are around. For flow income, it looks like mostly it's statutory rates, but for inheritances, it's clearly more reliefs. But it's important to realize that the inability to tackle those constraints highlight the kinds of difficulty we'd have with any kinds of context where we want to tax billionaires. It doesn't mean we shouldn't think about it, but if we're struggling in this group, who are clearly much less extremely wealthy than the billionaires are, this is a group that are more numerous, but in some sense much less politically powerful. And so if we struggle here, we should be aware how hard it would be to try to institute something like a tax on billionaires. The other thing I wanted to say, one of the reasons I showed you all this immigration stuff, is that, certainly in the UK, immigration effects, while not trivial, are well below any kind of LAFA rate. So coordination is a great thing. Coordination is only going to make it, less costly in the sense, fiscally, in the sense that people are less inclined to leave if they're going to pay the same tax somewhere else. But you can actually go quite a long way without coordination if you think that, for the most part, even though some people will leave, the ones who are leaving are relatively less costly to lose. You can actually do quite a lot just sort of within one country. So that's the other thing I think it's important for us to think about when we're having discussions about the design of taxes on the rich. I'll leave it there. Thanks.
Thank you so much, Arun. So we have a bit of time for questions for Arun and Demetrio first, and then if you want to ask questions for the 4 panelists, you can also. So we have a question here.
Thank you for the second 2 presentations. Absolutely love them. But Arun, your one, what I really found interesting was this movement of people. I think that's always sort of, that was the elephant in the room. That was always people who say, oh, people would leave. Which brings me to the sort of policy coordination issue. We know certain jurisdictions, usually they're small open economies, explicitly market themselves as places where you can set up family offices, places that offer golden visas, and so on and so forth. In a policy coordination space, what do you think is or this is for most of the people, what do you think is the room for sort of, so far, things like the OECD harmful tax practices have largely talked about the corporate side. What about looking at the personal income tax side and saying that, look, I mean, this is a sort of harmful behavior if you're trying to, it's a beggar thy neighbor sort of policy. Just thoughts on that. Thank you.
Yes, it's a really important point. I think there's in a sense, the point that I made with the migration work is that for many wealthy people, actually because more and more wealth is actually connected to, as we know, business wealth that relates to the work that people are doing, means that there are many wealthy people who aren't completely kind of unlimitedly mobile. And so that means that you can actually get a lot of tax from people without having to do the coordination. But the point being made is that actually it's also the case that there are some people who are, for example, just inherited some wealth. It's all in a trust. They can live anywhere they want. They might as well keep it somewhere where it's outside of a taxable jurisdiction effectively. That bit won't be tackled without some coordination effectively. I think it is a much harder problem than the corporate example that you gave, because thinking out what the individual version of a UTPR looks like that sort of allows a country to enforce on somebody who's not based in their country is much harder, right? So I think for corporates, for those who haven't followed all of this debate, for corporates, the structure is there's sort of 3 levels of tax, where first the country where you're doing the work has taxing rights, then the headquarter country has taxing rights, and then any other country where you have a presence has taxing rights to make sure you get to your minimum, as a company, minimum level of tax. And that works because for the large corporates we're thinking about, they have a presence across a huge range of jurisdictions, and they're not realistically going to give up on being in so many of those jurisdictions. So because they have to file anyway, because they have a presence anyway, there's a way to get money from them. It's clearly an important issue, a very important issue on the personal tax side, but it's a much harder problem because it's hard to work out how do you say, well, France has the right to tax some US billionaire who's chosen to set up their family office in the US Virgin Islands. Like, if the US chooses not to enforce a tax, and that person doesn't doesn't live in France, how is France going to enforce it? How is the UK going to enforce it? So I think it does require a different level of coordination, where it's really more about trying to negotiate with countries to a level, but there isn't a self-reinforcing mechanism we have for companies. But I mean, Gabriel might say more at a different point. I know he's thought about this a lot.
There is a question here. Sorry, okay, no, you guys, I haven't seen. There is a question here?
Yes, I have a question. Many compliments to the speakers. I wish I could hear something about inheritance and donation taxes out of Advani, because Arun was very clear on the UK perspective. But starting from Demetrio, for example, I wish I could hear whether you consider inheritance taxes from within the wealth tax, and an evaluation about the mobility of individuals, which is a big issue all over the world, because I think that taxation of billionaires coincides with the idea of having people very mobile all over the world, and that's going to be another crucial point, whether everybody has the duty to pay taxes if it is always mobile all over the jurisdictions.
Yeah, thank you for the question regarding the inheritance part. So in Italy, probably Italy has the lowest level of inheritance taxation across all the OECD countries. So for the case specifically of Italy, inheritance taxes account very little. In the paper, I didn't show it here because in the paper we do an exercise including inheritance taxes, which don't change the overall macroeconomic effect of the average tax rate. And we also, in that exercise, we put all the inheritance taxes at the top of the wealth distribution and change very, very little. It's barely visible. So for the case of Italy, that's not really an issue. The problem will be on increasing the inheritance taxes because the threshold for paying it is very high, and anyway, the tax rate is also very low. So yeah, this is the point on inheritance, and also the issue I think on how to distribute inheritance taxes is a bit difficult because it should be one should understand whether you want to consider that it is paid by the people who receive the holdings, the wealth, or it is paid by the people who have left the wealth. So with this data, it was a bit it's a bit unclear on how you want to distribute it. But anyway, in the exercise we did, it didn't count anything. So this is why we didn't show it here. Yeah. Thank you.
And on the question about sort of duty to pay tax, I mean, I think I as an economist, think very practically about what can you design and what should you try to design in terms of, is it sensible, is it equitable, is it efficient? What you sort of have a duty to do, I don't have a good sense for. I mean, I think it's clearly the case that it's hard to look at a situation in which some people can avoid paying tax anywhere and think, oh yeah, that's a sensible system, that's a well-designed, fair system. But whether, how you go about then designing a system that means that they do pay tax somewhere, I think is the challenge that we're all facing. And I think is a lot of what we're going to be hearing over the next couple of days. It's like, what does it look like to build a system that actually makes that enforceable and effective?
Thank you. There is one question here, then one here, and one here.
Hi. Hi, thank you for the presentation. I'm here. My question is about coordination. Like, one way to tax is coordination, but what are your thoughts on exit taxes?
So personally, I think that it makes sense to have an exit tax. Many countries do. So in the G7, actually, we represent the two countries in the G7 that have nothing like an exit tax, in the UK and Italy. But the US has one when you expatriate from citizenship. Canada has one. Australia has one. The rest of the European Union, where they have them, they've become relatively less effective because of Commission rulings that changed how they work, or that changed how they chose to implement them. And I think designing something that looks more like effectively a deemed disposal is what you'd want to have. So that then when people move from a country, they are paying tax on the gains they've built up in that time. I think that's a totally sensible and natural thing to do. It's pretty hard to explain why you wouldn't want one of those if you think about it as, in an ideal, coming back to the points I made earlier, in an ideal world, we think of Haig-Simon's income as a kind of measure of what my capacity to spend is in principle. I may not spend all of it now, but that's my capacity to spend. Now, for very sensible reasons, we don't, I think, tax on accrued gains. One, it's administratively difficult. Two, I may want to retain those earnings and get higher return from them in investing, and it's costly for me to extract that now rather than to get that. But we think of that really as a kind of administrative issue that we allow people to defer those gains. We expect them to be taxed at some point. So the problem then in the capital gains tax system is we then have leaks that allow people to get out of the system altogether, where that sensible allowing for administrative ease of not having to pay the tax now suddenly becomes an exemption when I die and I can pass it on, it's all written off, or when I leave the country and it's not taxable. So I think absolutely we should be talking about exit taxes. The EU needs to tighten up the ones that it does have, and our countries that don't have them need to introduce them.
Okay, so there is a question here first, and then we'll take this one and get.
Thank you very much. Fascinating presentation. Giovanni Occhiali from the International Center for Tax and Development. We work a lot with low-income countries in Africa that are trying to increase taxation of the wealthy. And something that Arun said really struck me. When the taxes we already have are clearly not working well enough, and the political capital available to push through tax reform is so scarce across high and low-income countries, should we prioritize fixing what we already have and then try to fight the fight for the wealth tax? Could we do both at once? That's just for anyone on the panel, really. Where should we start from, given what we can do?
I've got the mic, so I guess I'll go first. I mean, happy to share with anyone else. So a few years ago, Andy Summers, Emma Chamberlain, who's a barrister in the UK, and I ran the UK's Wealth Tax Commission. And one of the things that we said very strongly there was, even in a world in which you want a wealth tax, and there's cases for and there's cases against, but I think there's a reasonable case for a wealth tax, but it seems difficult to say that the first priority should be to introduce that when you have lots of other taxes on wealth that are not working well, because it's hard to see that you would have the ability to design that one well if you can't fix the others. And so layering kind of a new bad tax on top of other taxes to us didn't seem like a good idea. We'd want to fix those taxes first. There's then a case potentially for adding a wealth tax on top. I think particularly from a low and also middle income country context, a big reason also, a big difficulty that you face is the kind of revenue mobilization generally, right? Like expanding fiscal capacity through just having tax revenue is important. In high income countries, the kind of conversation is around what we have usually relatively well-functioning income taxes for most of the distribution, relatively well-functioning VAT type systems. US again is an exception for most things. And therefore we have quite a large, we can generate quite a large share of GDP as tax revenue. And so at the margin when we're having that conversation, the question is, do you want to tax everybody a bit more on their income, or do you want to tax the wealthiest a bit more on when they're already paying, as we've seen, a lower effective rate? And that's, I think, where those conversations come from. I think in the low-income country context, where you're struggling with total, like the massive revenue in general, building those very basic taxes to work effectively is, I would say, the priority, because if you can't get those to work properly, you're just going to struggle. And the marginal revenue you get from just having that wealth tax, given the number of billionaires you'll have, is 100 millionaires you'll have, is pretty low. So I wouldn't prioritize that personally. But open to anyone else.
Okay, so there is a question here, second row.
Hi, I'm Elisa Palagi from Scuola Superiore Sant'Ann, a co-author of Demetrio, so my questions are for Arun, of course. Yeah, the first question was more about the exit tax. You briefly already talked about it. I was wondering what you think would be the change in migration values in a counterfactual scenario where an exit tax. So how much do you think it works, actually? And then I was interested in understanding a bit more your design of the 2025 papers. So what is the control group? How did you build it? And just to understand a bit more of details about that.
Cool. So first on the more niche question of the details of our paper, we are comparing, and there's lots of different things we do in the paper, but the main specification is comparing people who are not yet affected by a reform that's going to eventually increase their tax rates by them being brought into tax on their foreign investment income, foreign returns on gains and foreign earnings, and comparing them to people who are 15 to 20 years in the UK and therefore are already affected. And so that's where you saw those two control and treatment lines. And that's nice because it means that we can compare people at the same levels of wealth. And we can say, well, how does this vary across the wealth distribution or across the income distribution? I didn't show you all the heterogeneity today because I could do a whole presentation just on that. But we can compare people who are similar in all of the other ways. It's just they happen to have arrived in the UK at different points in time. So that's effectively the kind of core of what we're doing. We also have some variation in there of different control groups in case you're worried about anticipation and so on. On the point about exit taxes, I think that if you were to have an exit tax, clearly it changes the dynamic a bit when you're thinking about migrating in response to some other tax change. So you'd expect it to lower that migration elasticity generally because, not to zero, clearly by leaving all future returns that you're getting will be outside of the domestic tax net, but all of those built up gains would become taxable. And so there's a real cost to you of choosing to leave. And I would expect that to lower the elasticity. I don't have a kind of quantitative answer to how much, but I'd expect it to go down.
Thank you. We have a question from Gabriel.
Thank you so much. My question is for Demetrio and Arun. And first of all, thanks for truly excellent presentations. And I was curious about what it would take to extend your work to capture, the very, very top of the distribution, like Laurent and Wouter did. So, what do you think are the main obstacles to doing that in the Italian and British context? And perhaps most importantly, how can we overcome those obstacles? And what's kind of the minimal study that would be possible in the context of these two countries? Perhaps concretely, I think the simplest study that can be done is you take named lists of very rich people from Sunday Times in the UK, from Forbes or similar magazines in Italy, and you try to merge those individuals to tax returns to compute their effective tax rates and try to use external sources to capture business income. Do you think that such a study could be done? What would it take to make that happen?
Yeah, and regarding Italy, yes, the thing that you're saying, it could be possible if from the government from the ministry gives information on income taxes paid by billionaires. I mean, having the list of people, it's relatively easy because they're on the Forbes list. You will be getting only the top 0.01%, so only the billionaires. The issue is that, as far as I know, also considering the new government, I don't think this is really think that it's possible because it has never been done. As far as I know, no researcher have been able to use microdata on income taxes or similar sources. Also, people who are in the ministry and do research on that, they always have tabulated data. So this is why I'm a bit skeptical of the feasibility of it. Also given the new government, so I don't know. Yes, we tried something using the data on the information available on the past president, which was Berlusconi, which was also used in other papers, where because he was member of the parliament, there need to be some disclosures on his income. On his income and on his holdings. So we used some of that we used to do the estimation for the billionaires, and we use it as a proxy for all the billionaires. But yeah, if it will be possible to have just information on their income, then having information on their assets is kind of possible, because we did it as we did for Berlusconi. We could do it for the others. So yeah, this is.
In the UK, we, I think, could in principle link up the data to do the retained earnings kind of things that were done in the other studies. We access data in the UK through the HMRC Data Lab, which is the approach that allows us to access the kind of micro data. So we're in a better position than Italy. I can't imagine, I mean, from many conversations with the tax authority about what you can and can't take into the Data Lab, I can't imagine any world in which they let you take, or let anyone take the Sunday Times Rich List or equivalent into the lab to link together. I know it would be anonymized to do it, but it's just not something that they would countenance. The sort of risk tolerance is pretty low in terms of what they're willing to do in terms of bringing things in. So I can't see that being something they would ever accept. The pure kind of retained earnings thing and just saying, well, what we can get directly from that, I think is sort of in principle doable.
Okay, so we have time for one last question here.
Hello, Nadia Novitska, University of Luxembourg, and thank you for a brilliant presentation. And I have a question for Arun. Did you analyze what happens with migrants from Ukraine and Russia after the war in Ukraine began? And how many billionaires was relocated in the UK from Russia from this time? Thank you.
So it's a really good question. So I guess two things to say. So I mean, there's the different timings. So there's 2014, I guess, and there's 2022. We only just got the 2022 data, so we wouldn't have been able to do anything with that. One could look after the initial invasion in 2014. We do have data on nationality. I think one thing to say, though, is that something that surprised us a bit, certainly surprised me a bit when I first started working on the non-doms as a very wealthy population in the UK, was the countries that are mainly represented there are sort of Western Europe, the US and India. It is not a lot of the Middle East, there's not a lot of Russia. And initially that surprised me, and then I realized that actually it's because we think those groups are more likely to become non-resident in the UK. So they spend time in the UK, but they stay below the various thresholds that are out there that allow them to not become taxable in the UK in the first place. And so the non-dom regime is the wrong way to look at them. It's actually, they're probably just not resident in the UK. And so they might spend, there are lots of famous cases of individuals who we know spend time there and have particular houses there, and you see in own football clubs in the UK. But despite knowing all of those things about them, they aren't necessarily taxable in the UK if they're not spending quite enough time in the UK. So we actually don't have necessarily the best data source for doing anything on that.
Okay, thank you. This is the end of the panel. Thank you so much for our 4 speakers for their presentation.